This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Tuesday morning, we're coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, as always, my colleagues Sonia and Nigel. Guys, hi, morning.
Hi, good morning. Don't remind us on a Tuesday that it's a Tuesday morning. You're only allowed to say that on Thursdays and on Fridays, right? That it's a Thursday morning or a Friday morning. Otherwise, then just don't mention it. But I mean, looks like it's not too bad. The cues from across the globe, at least, are not bad today.
It's not bad, actually. I mean, we got a bit of a risk on overnight as well, and that's basically what we want to start with. By the way, yesterday we got a good follow-through, and I think that has to be said. We were kind of talking about this on Friday. We were talking about this actually before that as well. Finally, we got a decent kind of a move. The Nifty ended about 0.4%. Not quite the day's high, but not very far away either. By the way, the high yesterday was 19,621, which is almost at the 20-day moving average. That's the first marker that we've been putting out that the market needs to climb get its head above and close. Well, global risk sentiment, as I said, is a bit better. The S&P is up 0.9, the Dow is up 1, the Nasdaq is up about 0.5% as well. Dollar index, no incremental fresh move higher, flattish, 102.07. Oil prices, well, they came off a little bit, but they're just holding just under the $86 per barrel mark. This is Brent oil prices. So incrementally, there is nothing. News flow-wise as well overnight, there was nothing new. But, looking ahead, there is going to be a fair bit of news flow, and most of this is around, data and what central banks may do. So we've got the RBI decision, which we will get on Thursday morning here. And then same evening, Thursday evening, US time, we'll get US CPI numbers. So I think those two are the big ones for markets, both here in US. And of course, what happens to the US market, because there's been so much back and forth about whether, we'll see a soft landing and whether they can actually get inflation down to 2% without causing some kind of a recessionary environment. I think this number, the CPI number, perhaps becomes globally important for markets. All right, coming back here, I think it's pretty simple, not very complicated in terms of what the market needs to do. It needs to close above the 20-day moving average. We almost got to it. It's moved up. The average has also moved up a little bit. It stands at 19,639. We left off almost at 19,600. So, 40 points more. You get a healthy, decent close above it. And I think confidence starts to come back a little bit more. The 61.8% retracement of the recent fall, the 350-odd point fall that we saw, it stands at 19,726. So you get a close above that 20-day. The next target, the next level, which you need to cross, is 19,726. On the downside, I think last Thursday's low is the one that really would matter in case some selling starts to come in. But that is some distance away. That stands at about 19,300. On the Bank Nifty, it was a bit of a lethargic kind of session. It didn't do anything at all. Absolutely flat. Did not participate in the up move. For the Nifty Bank also, the 20-day stands at 45,356, and that's the level which the Bank Nifty needs to cross and close above for enthusiasm to start to come back. Mid caps and small caps closed higher, 0.25%, 0.5%. So broader market action still remains quite okay. Although I have to point out, lots of earnings have disappointed, and stocks are reacting. Large stocks, liquid stocks, well-owned stocks, between 5, 6, 7%. And we saw lots of that kind of action yesterday. So a lot of pullback going on as well on heavy volume. So keep an eye out on that. Otherwise, the GIFT Nifty is indicating a flattish kind of start, 20 points lower. Sonia.
Okay, well, we are virtually now once again getting to this all-time high territory, right? Just 300-400 points away from that 20,000 mark. So let's see whether we can get there. The bulls tried to make a bit of a comeback overnight. So the US futures are a little unchanged. But if you look at what happened overnight in the Dow, 400 points higher. The S&P 500 ended the 4-day losing streak. So the bulls are sort of making a comeback globally. The Nifty, as I said, has been holding on to the 19,600 mark. And there was large buying from DIIs yesterday, while FIs continue to sell for the 10th straight session. FIs have now sold over 10,000 crores in August so far. So see, the bias is definitely on the upside now that global cues are also back. In terms of earnings, what came through post-market hours yesterday, I'm looking at some of the good ones. You had Godrej Consumers, which reported a volume growth of almost 10%, so the street would like that. Max Health, Torrent Pharma reported a good set of numbers as well. PB Fintech reported an operational profit versus a loss last year, and a lot of these platform companies are in focus, so keep an eye out on that. And yesterday, we saw the pharma and IT stocks rally. In fact, Divi's Labs is now amongst the top Nifty gainer this year, so do keep an eye out on that. And in terms of earnings today, you have Hindalco Coal India that will be reporting their numbers. So lots of stock-specific action. But I reckon this market is slowly and steadily getting back to those all-time highs. It's just a matter of time. Until then, little bit of a range-bound movement.
Well, that's right, Sonia. And the Nifty Bank needs to perform because as the markets are only around 2%, the Nifty is only 2% away from its all-time highs, but the Nifty Bank is 3.5% away from its all-time highs, telling you that we have a bit of an underperformance that's coming from the Nifty Bank. So the Nifty Bank needs to fire. If that happens, we're headed towards the 20,000 mark yet again. Now, in yesterday's trading session, the FI as well, they lightened positions, both on the long as well as on the short side, though they continue to remain short with close to 55% of their positions on the short side. Just a few sessions ago, we were highlighting that the FI net short positions in contracts, well, they were at around 41,000 odd. Now, in the last few days, because of lightening of positions on the short side, well, we're seeing that number come down to around 19,000. When we're talking about net short positions, it's the FI short positions, and from that, you deduct the long positioning. So that's come down a little bit. So some part of those shorts have covered out. Now, today is the Nifty Financial Services Index expiry. So the second half of trade belongs to the Nifty Financial Services. It's holding a little above the 20,000 odd mark. The 20,000 put has the highest open interest on the put side. And yesterday, that was fairly active. Close to around 40 lakh shares were added out there. The premium's around 44 rupees odd. So just going by that data point, highest open interest added around the 20,000 put, premium of around 40 to around 50 rupees. You get your crucial support zone of around 19,950. That's on the Nifty Financial Services Index. That's the number you need to watch on the downside. Moving to the Nifty options data, well, there was some put writing, 19,500, 19,550 between them. They added close to around 80 lakh shares odd. So to get to the levels then, the 20 DMA needs to be conquered on a closing basis. And that number comes up for you on the screen. However, since we saw 19,500 puts see a good amount of open interest built up, on the downside, 19,460 odd becomes an important support zone. But the Nifty Bank, that holds the key. It has to give up this underperformance that we are seeing, and you want the Nifty Bank to head towards its 20 DMA. If that happens, then we're well and truly on for the 20,000 odd mark. In the near term, though, Nifty needs to cross that 20 DMA on a closing basis, and the Nifty Bank needs to perform. I don't know whether it's going to come from HDFC Bank or a couple of those Nifty Bank heavyweights, but that needs to fire. For starters, we start off with a cut of close to around 40 points.
Just one word, and of course we'll get that whole view in just a bit, but Motilal Oswal said that the banking earnings this time, they believe that the best of the banking earnings is behind us, and there's moderation in net interest margins now. So they've also sort of churned out of banks, and maybe that's a narrative that the street is also working with.
I think one thing we've seen across bank earnings is NIM compression, right?
Yeah.
I mean, through and through. I mean, without exception, I think, starting with the largest, which is SBI, down the curve.
I think what happened with SBI also, the growth wasn't as much, so NIM compression, and that, soured sentiment a little bit.
Absolutely. Well, we'll discuss this in greater detail as we go on. But before we go any further, let's quickly tell you what's lined up here in the first half hour of the show. We get you updates from markets across the globe. Rajat Bhattacharya, Standard Chartered, will join in to discuss the sort of global view. Our research team will get you CNBC-TV18's list of top 10 stocks for the day. At 8:30, we'll have Amisha Vora of Prabhudas Lilladher to talk to us about what she likes, themes she wants to bet on.
Okay, so let's kickstart the show with that view that we just spoke about. Gautam Duggad of Motilal Oswal. He expects a range-bound market with a positive bias. He says corporate earnings have been in line to slightly better than what he expected. Autos, NBFCs, hotel stocks, real estate, discretionary stocks look good now. And they are advising shifting capital away from banks and into NBFCs. He feels the best quarter for banks is behind us and margins will moderate further from here. He also says that auto numbers have been very strong this quarter, and among specific stocks, they like Zomato. They actually had gone overweight on Zomato a month ago. It's worked out well for them. They like Indian Hotels, Mahindra & Mahindra and Titan.
Okay, let's get you some money market views here. Abhishek Goenka of IFA Global says Fitch downgraded US sovereign ratings, selling pressure in domestic equities and higher crude prices continue to hurt sentiment. He says one-year forward yield has dropped further to 1.6%, and at such depressed forward levels, there is little interest among exporters to hedge long-term exposures. Nonetheless, he adds, we have been seeing the central bank intervene around 82.8 to the dollar levels. He expects resistance at 82.9 to hold and will continue to see the USD INR pair trade in a range of between 81.6 to 82.9 over the medium term.
Okay, and on the bonds, Ajay Magnolia of JM Financial says continuous upward trend in US yields post rate hike, ratings downgrade and inflation concerns has kept traders cautious. He said ahead of the RBI policy, market is likely to trade in a narrow range and the RBI MPC is expected to hold rates but might turn hawkish in its inflation commentary. He expects the 10-year benchmark bond yield to trade in a range of 7.17 to 7.23% for the day.
Well, we've got a lot of stocks that we're going to be tracking for you since it's almost the end of earnings season. So let's get the list up for you on the screen that we'll be covering in our special Top 10 segment. We're looking at Godrej Consumer, Tata Chemicals, Max Healthcare, Torrent Pharma, PB Fintech, Gland Pharma, MedPlus Health, Indigo Paints, HDFC Bank, and Manappuram Finance. Well, all of them expected to open up in the green and react to positive news flow.
Okay, well, it's all green as far as stock reactions are concerned. Rajat Bhattacharya is with us. He's a senior investment strategist at Standard Chartered. He's joining us now. Rajat, good to have you with us here. Thank you very much for your time. How important is the CPI number out of the US? And before that, in the morning, day after here, India time, we get the RBI decision. You know, many are expecting a hold here, a hawkish hold, if there was one. What's your sense? How important is Thursday going to be to set the direction from here on?
Morning, Prashant. Yes, Thursday is an important day. I mean, as you said, not much happening this week so far. But two things on those two events that you mentioned. On CPI, we need to see numbers below 0.2% month on month. Why? Because that is the number. If US CPI constantly reports below that 0.2% month on month number for a few months, then it will go towards that. Then US overall annual CPI will go towards the 2% target that the Fed is targeting. And unless we get that number, you're probably going to see the inflation reversing back in the fourth quarter, because currently you have the base effects playing, right? So base effects is bringing down inflation. The disinflation is led a lot by base inflation. So we need to see that number. And to your point about RBI, a lot is, I mean, they are also taking cues from the global setup, right? So we have seen some emerging market central banks start to cut rates. We saw Brazil and Mexico on cutting rates, but RBI will, of course, go by Indian inflation trajectory, but a lot of that also depends on what happens in the global markets. So yeah, I mean, the hold is probably what we are likely to see until we get further signs of disinflation.
All right, Rajat, hi, good morning, and great having you on the channel. It's been such a great ride for retail investors, right? I mean, the Indian markets are up 10% already this year. The mid-cap end of the market is up 20%, and this is after so much bad news was thrown at us. Do you see more upsides, and how does an investor approach it now?
Yeah, hi, Sonia. You're absolutely right, and that basically brings to the point that we've been almost harping on for quite a while, is that the need to stay invested. This is the core thing that our core message has been all through the year. The main lesson so far this year is maintaining a broader foundation asset allocation. If you had that, you would have benefited from any rise. Obviously, there's a lot of volatility that has happened, and you know, a lot of markets and a lot of people were caught off step by this turn, the rebound. And that is particularly true for Indian assets. So staying invested is one key lesson. To your question about whether we see further rise, obviously Indian markets are stretched, and we know that. We know the valuation. We know why they are, because of healthy earnings and healthy return on equity. Indian markets are expensive related to the global setup. But fund managers globally are waking up to the idea of a structural bull market in India, right? So, and that's because of a lot of the things that I highlighted in my last call. Indian growth story is an idiosyncratic story in the emerging market space. India is expected to grow continuously over the next decade, let's say, on a 6 to 7% clip at least. Indian earnings are delivering. So they see India as an idiosyncratic case within emerging markets or even globally. And this is what builds the structural story for India.
Hi, Rajat. Good morning. So India, we are thumping the table as well. This decade belongs to India. Things are looking up. So it's a longer good story. But in the near term, do you think there is a risk that money starts moving towards China, given the kind of valuations, given the kind of sound bites? Or do you maintain that, no, you continue to remain bullish on India and India's top priority?
Yeah, within Asia, China is obviously at the rock bottom, right? So the valuation is almost half of India. So if you look at a 5 to 7 year trajectory, probably investing in China, adding more to China at this stage probably won't go wrong. But your point about timing, and this is where we come through. China data has disappointed so far, and there's no sign that they're going to pump prime significantly. They are trying to support growth. They're trying to boost consumption. And that is probably going to, we need to see more of that, especially in the property market. But there's an overhang, property sector overhang in China. So relative, the long-term story between the two, the structural story is in favoring India. For the short term, if China delivers on some more stimulus, you could see some upside in China as well.
All right, we let you go on that note. Thanks a lot, Rajat, for stopping by and speaking to CNBC-TV18. That's Standard Chartered talking about how the Indian market is a bit stretched at this point in time, but earnings are looking quite good. Let's slip into a quick break. On the other side of the break, we have our entire research team joining in to help us with the list of top 10 stocks. Stay tuned. Welcome back. Our entire research team is joining in now to help us with the list of top 10 stocks for the day. All eyes will be on Godrej Consumer after they reported their numbers. Mangalam is here to tell us more about that. Mangalam, morning.
Good morning. So Godrej Consumer, if you just take a look at the reported numbers, they may appear that they are slightly below analyst expectations. But this time around, you give the analyst the benefit of doubt because of so many moving parts itself in the company's numbers. The EBITDA was impacted by company plowing back a little more on ad spends, and the net profit was also impacted by an exceptional loss of 82 crores on account of stamp duty. But no problems with the internals, and they're rather strong. The India volume growth has come in at 12%. That's a positive, of which the organic volume growth has been 10% itself. Gross margins have expanded by over 700 basis points. The company's plowed that back into ad spends, which have come at 9.3% of sales versus 6.4% earlier. The India business saw a revenue growth of 8%, but volume growth was much higher. The company has given price cuts to consumers, and the margins out there expanded from 22% to 32% itself. And the bigger trigger for them is scale-up of Park Avenue. They've done 48 crores of sales this time around, but the sales in the market, secondary sales, have been nearly 2x of that. So those are some positives. Expect the stock to be in the green despite a mild miss on reported numbers.
All right, Mangalam, thanks for that. So internals look strong on Godrej Consumer. Let's hop across to Sonal. Sonal, what about Tata Chemicals? How are the numbers?
Well, on the margin front, Nigel, Tata Chemicals was better than estimated, and this has come in at a time when the company went ahead with soda ash price cuts in the quarter gone by. Revenues, they were up 5.5%, slightly lower than Kotak estimates. However, EBITDA was up 3%. Margins came in at 24.7% versus an expectation of 23.2%. Profits were down 8% to come in at 587 crore rupees. The company says higher revenues were led by higher realizations, but volumes were impacted. Their net debt, however, has increased on a quarter-on-quarter basis. Morgan Stanley says the company reported highest ever EBITDA as margins surprised positively, offsetting lower volumes. The con call is at 8:30, and we'll get you more details on this one.
All right, thanks very much, Sonal, for that. Well, Max Healthcare reported numbers, and so did Torrent Pharma. Ekta is here with both. Ekta, morning.
Thanks for that. Well, I'll start with Max. Good performance coming in for the hospital company. Revenue was up around 17%, margins 26.7%, profit up 27%, and that was driven by the average revenue per occupied bed, which was up 13% year on year. Occupancy was flat year on year, lower Q on Q, but the average revenue per occupied bed made up for it. International patient revenue was up 31% year on year. Cash on books remains strong at 957 crores. Torrent, largely in-line set of numbers, revenue up 10%, margins 30.5%, profit up 7%. But India did well, double-digit growth there led by the Curatio acquisition. Adjusted growth in Brazil was stable, up around 12%. Germany was up 21%. US sales were better than estimates at 36 million versus estimates of 34 to 35 million. And that's the reason I'm going for green for both these stocks. Good performance for both of them.
Okay, thanks a lot for that. Max and Torrent looking pretty good. Surbhi is joining in to tell us how PB Fintech did this quarter around. Surbhi, over to you.
Thanks so much for that. So PB Fintech reported a strong revenue growth of 32% now, which is largely led by the core online business. In a seasonally weak quarter, they've grown over 39% in that segment. The new initiative segment grew by 11%. The adjusted EBITDA has come in at 23 crores versus a loss of 66 crores same time last year. But sequentially, it has seen a decline of 5 odd crores. Now, most of the growth has come from the online business, which reported an adjusted EBITDA of 69 crores versus 64 crores in the previous quarter and just 5 crores same time last year. New initiatives losses have narrowed on a year-on-year basis, but sequentially they have expanded marginally. The adjusted EBITDA margin was flat sequentially. The net loss is at now 12 crores versus a loss of 204 crores same time last year. The stock has rallied close to 14% this month itself, so let's see which way it goes. But strong numbers coming in from PB Fintech.
Okay, all right. Thanks a lot for that, Surbhi. Well, let's hop across to Ekta. She's standing by to tell us about some of those pharma-related names that came out with numbers. Ekta?
Well, I'm definitely watching Gland today because I think it was an excellent recovery that they've shown on a Q-on-Q basis as well as on a year-on-year basis. So revenue was up 41% year-on-year. Street was anticipating a 34% growth. Margins 24% versus 31.5%, but it's been a Q-on-Q recovery, which I'll come to in just a minute. Profit was down 26%, but it was in line with estimates. Q-on-Q revenue 1,209 versus 784.
Okay, Ekta, I can't hear you, so I think we'll have to sort of just come back to you in a bit. But those are a whole host of, stocks that are in the news. Mangalam is also with us to talk about Indigo Paints. That one looked like a strong showing, Mangalam.
It was a strong showing. In fact, the result of the season in the paint sector for sure, because it's the fastest growth in the industry. It's among the smaller players. It's grown 3 times the industry growth rate. And the company has had a differentiated focus on Tier 1 and Tier 2 cities, and that's aided the growth itself. I mean, just for perspective, Indigo Paints grew 29% in the first quarter, and we have numbers from Kansai and Asian Paints. Both of them had grown anywhere between 5 to 7% itself. Has that 29% growth on the top line percolated down to the bottom line? Yes, and more. The EBITDA has actually jumped by 39%, and the net profit has increased by 58% as well. Ad spends for the company have been curtailed from 9.4% of sales to 7.6%, but this is on a pro rata basis. As against absolute numbers, they've been largely unchanged year on year. Good set of numbers. See the stock in bright green.
All right, at 9:50 a.m. today, we'll be joined by Hemant Jalan, the Chairman and Managing Director at Indigo Paints. So you'd want to listen into that one after a good set of numbers. But Ekta is back with us to talk about Gland Pharma and MedPlus. Ekta, go ahead.
Well, Gland Pharma expect the stock to be in the green because it's been a Q-on-Q recovery. Margins 24% versus 31% year-on-year, but versus 21% on a Q-on-Q basis. Profit also largely in line with estimates, but the revenue was up 41% year-on-year. That was aided by US revenue, which was up 25% Q-on-Q. They've seen improvement in terms of volumes. Price erosion has stabilized. Europe has been strong because of a latest acquisition that they made recently. India was up 29% year-on-year. Rest of the world, which is 24% of sales, was up 193% year-on-year, was up 72% Q-on-Q. So it's been a clear outperformance in terms of what they have reported this time round. Now, in terms of MedPlus, it's pretty much been a stable set of numbers except for the revenue, which has been strong. So that's why I'm going for green. Revenue up 29%, margins 5.6 versus 5.3%, profit 3.78 versus 3.2 crores year-on-year.
All right, Ekta, thanks very much for that. Well, let's get back to banking. HDFC Bank is, I think, now, after that merger, part of the FTSE indices, and Manappuram Finance will also be in focus. Abhishek is here with both. Abhishek.
Well, Prashant, to begin with HDFC Bank, it was added to the relevant FTSE indices post the merger with HDFC Limited. So, in September 23 review, FTSE Russell will evaluate the eligibility status of HDFC Bank. This would include review of the shares that is there, free float and foreign headroom. Based on public information, the foreign headroom is about 18.3%, which satisfies minimum foreign headroom requirement for an index constituent. So, HDFC Bank is projected to increase weight in FTSE emerging all cap index from 0.81% to about 1.52%. Value-wise, I just saw the 31st July data. It would mean an additional $52.3 million inflow into HDFC Bank. So, to ensure replicability of the impacted indices, FTSE Russell proposes to implement the upweight of HDFC Bank in 3 tranches from September 23 to March 24, which is up on your screen. Another news is that Asirvad Microfinance over there, they have given the operational update. The NII is up about 90% YOY and about 28% sequentially. The NPA provisions have jumped up on a sequential basis by almost 61% quarter on quarter. However, the PAT is pretty robust over there, coming in at 161 crore when compared to 99.3 crore in the previous quarter, which is a jump of about 62%. Asset quality, slight hiccup over there, but seasonal in nature. Gross NPA is up to 2.9% versus 2.8%, and net NPA ratio up to 1.3% versus 1.1% in the previous quarter. Back to you.
All right, thanks a lot for that. Here's a quick recap of our top stocks with positive news flow. There's Godrej Consumer, Tata Chemicals, Max Healthcare, Torrent Pharma, PB Fintech, Gland Pharma, MedPlus Health, Indigo Paints, HDFC Bank and Manappuram Finance. While news-wise, there are no stocks on the radar with negative news flow. But let's find out what's happening in the world of commodities. Manisha Gupta joins in for a roundup of all the action there. Manisha, morning.
Morning, Sonia. Thank you for that. Well, the crude oil prices seem to have rebounded after a 1% decline overnight, as the market are looking at uncertain demand on one side, but then again, there are tightness in sense of supplies, especially coming in from Saudi Arabia and Russia. You also have seen production and inventories decline in US, while the demand continues to be on the steadier side. It's what's supporting crude prices. So we are back above $85 a barrel in Asian markets right now. The street is watching out for the U.S. Consumer Price Index. That comes on Thursday, and the PPI number on Friday. So it is going to be about the inflation numbers from China and U.S. that will drive the markets. While the crude prices have done well, can't say the same about the metals other sector, because whether you look at copper, aluminum, iron ore, steel, all of these have started Asia on a weaker note because of the strength in U.S. dollars.
All right, Manisha, thanks very much for that. Well, we'll take a quick commercial break here. Amisha Vora of Prabhudas Lilladher will join in for some fundamental stock check. We'll have the management of Kolte Patil Developers to talk about the quarter gone by and the guidance they've put out for FY24. Stay tuned.
Welcome back. You're tuned into Bazaar Morning Call here on CNBC-TV18. Well, let's analyze some of the stocks that we just discussed. And to help us out with that, we have Amisha Vora, Chairman, as well as Managing Director at Prabhudas Lilladher, who joins us. Hi, Amisha. Good morning. Thanks so much for joining in. Well, we are towards the end of earnings season. So let's focus on a couple of earnings that we got overnight. Godrej Consumer, the headline number didn't look too great. I mean, it was more or less in line, but the internals were rather strong. Your view on the pack as well as Godrej Consumer in particular?
See, the numbers did reflect that the categories that they are in, they are really investing well. And above all, they recently acquired from Raymond some of the brands. And I think within their network, these brands will grow quite well. So while they have paid quite a lot of cash, I feel that the new categories in medium term will bring a lot of growth. So I continue to remain positively biased on the stock.
Okay, continue to remain positively biased on the stock. Amisha, hi, good morning, and thanks for being with us. You know, one takeaway from this quarter's earnings is that a lot of platform companies have either turned around or improved their performance, right? Whether it's PB Fintech, Zomato, Paytm has been operationally profitable for 3 quarters now, and even something like a delivery. Would you buy any of these names?
So we were expecting, after the real collapse which happened in their valuations post-listing, and the fact that at those valuations raising capital also would be a bit of a question, that most of these companies will look internally, start re-evaluating their growth and profitability metrics. And we're starting to see the initial signs of turnaround. And markets have also given a thumbs up from the bottom that the stock had traded. But we will have to trade cautiously in picking and choosing the stocks which are having a real distinction. So if you ask me, PB Fintech and Zomato both are having a very large market share within their space. And because of which, I think that at the at some point in their journey, they will become very dominant and also profitable. So yes, a bottom fishing plus some place in the portfolio is a must.
Amisha, hi, good morning. Prashant here. Good to have you with us in the program. Two names, one is Britannia, where there was, I think, an all-round miss. Stock did fall yesterday. So any thoughts on that one? And then, I don't know if you have coverage on rate gain. It reported numbers in the last final hour of trade yesterday, and numbers seem to be very strong. We, by the way, have the management coming up a little later on the program. Go on, Amisha.
So Britannia in particular, will continue to have a little bit of pressure on margins, all because of wheat prices, milk prices, sugar prices. But having said that, I still believe that the penetration of Britannia biscuits still in the large heartlands of India, which is North and Bihar, is limited, and their continuous focus on expanding distribution there, plus value-added products, with a little consolidation in stock price for the short term, it will still be a good bet for the medium term. Coming to the second rate gain, I think that, right now we don't have a coverage, but it's a very solid business model. And when we were under active coverage, we were very, very bullish on the stock.
Okay, all right. Amisha, we'll be joined by a real estate company in just a bit. But for the time being, just want to focus on the pharma space. That's been a sector that really went through a big phase of consolidation. Not much move out there. However, the last few months have belonged to these pharma companies. Numbers are looking up. Maybe the worst of price erosion is behind them. And we have a couple of companies, Gland Pharma, Torrent Pharma, both of them came out with a set of numbers. What's your view on any of these names, and how do you approach the pharma space from here on?
Both are very different businesses. For example, Torrent is a fully domestic, largely domestic focused business. And if you see, they have benefited a lot because, as we understand, the API prices have started softening, with China coming back to conquer the volume growth. So the prices have started easing. At the same time, a lot of freight have 1/3, costs have become 1/3. So gross margin of most of the pharma companies have started growing. Apart from that, so Torrent Pharma actually benefited from that, and we continue to remain positive, and we have upgraded our target. But beyond that, the larger pharma story is around two things, particularly in US. That US market went through a very rough patch in generic business. As we stand in last quarter or so, some of the large generic players are probably likely to wind down. That is helping slightly inching up the pricing. And of course, the freight and API prices are also benefiting them. Once again, for example, a player like Sun Pharma, whom we like, is a very specialty basket that they have, and they are doing very well. Dr. Reddy's and Lupin have some one-offs permissions for their medicines, which has given them a big fillip and likely to continue till 25. So on the whole, the overall weightage on pharma, which had gone down substantially in last 4 years, is stabilizing, and so also the numbers which are coming back from the bottom. I think this trend will continue.
Trend will continue. If I remember correctly, this is a space that you have liked for a while, the pharma space. And now, of course, it's given great returns to investors as well. Misha, we'll just come back to you because, as Nigel was also pointing out, we have an interaction lined up with Colte Patil. For Q1, the company witnessed a healthy 52% surge in volumes, but declined sequentially. New launches contributed in Q1 to about 43% of pre-sales. Rahul Talele, the Group CEO at Colte Patil Developers, is joining us now to talk about that. Rahul, thanks a lot for joining in. Appreciate your time here. I wanted to understand whether this 700 crores of quarterly bookings that you've seen, is it something that is sustainable through the course of the year? And can you give us some signs of what the demand trends are looking like?
We are confident about sustainability of this kind of numbers. With the limited launches in last year, we could get these numbers in on a quarterly basis. So this is for the third consecutive time that we are achieving 700 crores plus pre-sales number for the group. And considering the strong launch pipeline in this financial year, already we have till date we have already launched more than 2,000 crores worth inventory. Certainly 3,000 crores plus more inventories lined up for launches in next few quarters in this financial year itself. So considering that, we are confident of achieving this 700 crores of run rate for this financial year.
Okay, all right. Hi,
And
Rahul.
in terms of division,
Go ahead.
see,
Yeah.
currently, our 24K product is moving very good. So that has contributed around 1/3 in terms of volume and around 45% in terms of value for us. And considering a strong launch pipeline, even in a 24K segment, we are confident of getting a good traction in 24K premium luxury product. And that is a trend in the market. People are willing to spend more for a spacious premium houses. So as compared to affordable, our premium contribution is going up and up quarter-on-quarter basis.
All right. Hi, Rahul. Given the fact that you're looking at maintaining this sort of a run rate, my guess is that maybe demand has not slowed down. Or are you seeing some kind of slowdown in terms of demand? And also tell us, what is the conversion rate right now? How many people come to see flats and then get converted? Is that ratio slowing down?
So we don't see any kind of demand slowing down in the geographies where we are currently operating. So if you see, there is a strong demand for because of the accumulated savings, because of the strong desire post-COVID. People are willing to spend more to have their own properties. Affordability is still at the very optimum level. On top of that, job security and the continuity in the job are the various factors that is driving the demand. And on top of that, in terms of sorry, what was the second part of your question?
I was asking you the conversion rate, sir. Rahul, you have say 20 people coming to see a flat and normally 5 are getting converted. As of now, what's the conversion rate?
So conversion ratio for us is, for a sustenance project, during a launch phase, our conversion ratio is around 15%. So 100 people are walk-in, 15 are the conversions for the MIG segment, maybe 10 to 12 for the premium segment. And in terms of the sustenance project, where we are not spending too much on the marketing, over there we are achieving a conversion of close to 9 to 10%.
Rahul, hi, good morning. So just a couple of points. You said that premium end of your portfolio is doing better and better. So that is where, you've given a guidance as well, right? What you need to what you will do in F5 24. I think a gross development value of some 8,000 crores. That's business development guidance that you put out. Will bulk of it be in the premium category? Will you gear yourself now consciously towards that?
Yes, certainly. So it is a complete supermarket. So we are going to have the acquisitions in the affordable MIG as well as the HIG products. So having said that, we have the current GDV land bank of around 25,000 crores. So some premium projects will get launched through that already land bank which is available with us. So flagship project Township, where we are planning to launch a couple of premium projects.
Okay, got it. No, I had a follow-up on that. After the super success of 24K Atria, what are the other projects that you launch in the next 6 to 12 months itself? And where do you see maximum revenue potential coming from in FY24 and 25?
So it is a 24 Altura that we have launched in last quarter. So over there, around 70% of inventory is sold out, whatever the inventory that we have launched within 1 month itself. And now we are planning to launch the second phase with the better price realization in that project. Apart from that, we have launched a 24K Manor project very recently, and one project at Township, that is 24K row house villa project. So we are confident of getting a good traction on all these 3 projects, and going forward also, we are planning to launch a couple of more 24K projects.
What is the per square feet average rate that you're getting for this project? This is in Baner, right?
Yes. So we have launched at we have underwritten this project a year back at 8,000 rupee. So we launched this project at 9,000 rupee a square feet on a sellable basis, and now in phase 2 we are planning to launch at 9,400 rupee a square feet.
Okay, got that. Appreciate you joining in, Rahul. Thank you very much for your time. As someone who spent some time in Pune, 20 years ago, Baner used to be, completely outside the city, but cities are expanding outwards. That's the way to go across the board. So congratulations as you kind of continue to add to your portfolio. So Land Bank with a GDV of 25,000 crores, that's basically the big number that I think they will continue to build on over the next couple of years. Kolte Patil at about 454. Amisha Vora is still with us. Amisha, any thoughts? Kolte Patil or any other real estate stocks you like?
So Kolte Patil as a stock has done very well, and as a management also over the years I've been observing they do a very good work. And now is the time when, pre-sales have started generating a lot of cash, and the whole business model has become very, very viable again. One of the other stocks that is not much in limelight, but I think we should do really well, is Suntech. We recently had an interaction, and we think that they're also set for a very good strategy, as well as the pre-sales and numbers will do very well.
All right, Amisha, request you to just stay on. We need to take a short commercial break. We'll come back in just a bit. Anuj Singhal will be joining in for a quick trade setup. Post that, we'll also bring you the top stock picks for the day from our technical and F&O experts. Stay tuned.
Okay, welcome back. There's 30 minutes to go for the pre-open session. Flattish kind of start is what the GIFT Nifty is indicating. Anuj is here with a quick trade setup. Anuj, morning.
Morning, Prashant. Well, you know what? I look at the current Indian market setup as basically a car which has 4 tires and 1 tire is punctured, and that's the Bank Nifty. You basically have 4 big sectors in Indian market: banks, IT, Reliance, and FMCG. Out of that, the other 3 are doing fairly okay, but banking is not doing okay, and that really is the problem. And of course, you have the spare tire, which is the pharma sector. That's doing well, but not helping a lot on the index. What happened yesterday though was very interesting. The Nifty ended at highest point of the day and the Bank Nifty ended at the lowest point of the day. That's a bit of a dichotomy that we have in the market. The Spin Nifty expiry today and the last 2 or 3 expiries have been quite poor. So I'm not counting much on the Bank Nifty today as well. It may continue its underperformance. So the bigger trade still is in IT and Pharma. That's 2 sectors which are doing well and have valuation comfort as well. On the Bank Nifty in particular, there are 4 main factors why it's underperforming after the earnings season. First is the net interest margin, clearly much weaker than what the street was pricing in. Second, a clear slowdown of credit growth, asset quality deterioration, and perhaps the valuations also slightly demanding. And to keep in mind, RBI monetary policy this week, it will be tough for RBI to be dovish this time given the recent inflation surge and global environment. So maybe you want to wait and watch and see how the Bank Nifty moves. Also, HDFC Bank in focus today. While the FTSE weight increase is positive, it was largely expected and it's happening in 3 tranches instead of 1. So technically, I'm actually taking it as a bit of a negative, not positive. Now, coming to Nifty then, yesterday we discussed that we made higher high and higher low, and there was a continuation of that, another new high, 19,620, and a better low, 19,524. So that, I think, is a good news. It closed above the 20-day exponential moving average as well. The first resistance is 19,600 to 19,620. Very small 20-point band, but that's the 10-day exponential moving average and yesterday's high. Bigger resistance is 19,680, which is the options base. If you cross that, then I think there can be a big rally. Not taking any view on the Bank Nifty today because, as I said, I want to wait and watch after the policy before taking a view.
Okay, all right, Anuj, thanks a lot for that. Well, let's get back to the conversation we are having with Amisha Vora. Amisha, last week, yet another big cement deal was announced, between Ambuja Cements as well as Sanghi Industries. In the last few days, those stocks, Sanghi has been doing well, but a couple of these smaller names like Orient Cement, I think in the last 1 week, it's up 25%. Seems like a bit of a valuation catch-up out there. How would you approach the cement pack? Would you stick to the large names, or do you believe some of these mid-small cap companies present more value?
So the first thing broadly about the sector, the cost pressure that the sector was facing, I think are really abating. So across the board, one would see that the margins will have a tick going up in the quarters to come. Also, the demand continues to remain reasonably strong, and it is a slightly domestic-oriented, largely domestic-oriented sector, unlike metals. So they are insulated. So I think the view on the sector is positive, and we will continue to see both volume and margin growth. And selectively, depending on, frankly, whether a mid-cap play or a large-cap play would more depend on whether you are a large mutual fund buyer or you are an individual buyer. There will be pick and choose. But the sector outlook is looking positive to me.
Okay, all right, Amisha. Thanks a lot for joining us and appreciate your time here on CNBC TV18. That's Amisha Vora of Prabhudas Lilladher. Let's talk to our technical guests now. Mitesh Thakkar and Sudarshan Sukhani join in. Gentlemen, morning to both of you. Sudarshan, this market has been a bit sticky around this 19,600 mark. Do you think the bulls are going to take it to the next leg of the upside? Considering that global cues are good, what do you do today?
I would think that we'll probably consolidate. It's difficult to identify the levels, the zone, but maybe 19,400 and 19,650 or maybe an initial starting point. So the trade is, because the market trend is up, we are coming from 16,800 to this level without stopping anywhere. The trade is still to buy the Nifty, but I'm not expecting big gains. I'm keeping my trades intraday, buy the Nifty on intraday dips, and then take whatever profits are available till this supposed trading range breaks on the upside. That may take time.
Mitesh, good morning. What about you? How are you looking at things?
Good morning, Prashant. I've been maintaining a negative bias, and my belief is that the market, actually might not have the strength to get past the gap which was created on last Wednesday. The levels are closer to about 19,680 to about 19,700. And my sense is that I think, we will possibly go back down. And once we start getting below 19,400 this time, I think then I'm penciling a target of 19,200. So mildly negative view, but I think, it all depends on the gap. And therefore, my shorting area is around 19,650, 620 zones with a stop just about 19,705. So that's the broad outlook. On the Bank Nifty as well, I think the same gap will come into play. So we'll be looking to short the financials as well as a couple of nifty names and the indices at higher levels. But I think IT and pharma will be the area where I would want to explore long positions.
Okay, IT and pharma is where you want to explore long positions. So take us through that. What are the names you like within the IT and pharma space? And in general, where are you bullish?
Yeah, so on my stock calls, I have a mix of buys and sells today. I have a sell on Bajaj Auto with a stop at 47.11 and a target of 45.80 is what I would look for. Amongst the IT names, I've chosen TCS as a buy call. Keep a stop below 34.50 here. Look for targets of 35.60. Adani Ports is also a buy call with a stop at 7.80 for a short trading target of around 815. And a sell call on GNFC with a stop at 568. Look for targets of around 540 on the downside.
Okay, got it. Sudarshan, good morning. What about you? What trades would you want to put on?
Yeah, good morning. Well, we have a stock in common with I and Mitesh. GNFC is a short sell for me also, but my suggestion always is to short sell stocks only intraday. So it's an intraday short with a stop above 575. Another stock that's available for short selling is Rain Cancel. That is having a similar decline as GNFC. It's not stopping. So intraday short with a stop above 166. The other two stocks are good quality stocks available for buying. You can keep this as a trade, a positional trade also if you wish. Sun Pharma is a buy, lifetime new highs. It's a breakout from a trading range after a big rally, supporting that breakout. So Sun Pharma is a buying opportunity with a stop under 1130. And Syngene is a buy. That stock had started a rally, then went into a small consolidation and just broke out of that. A very attractive chart. That's a buy with a stop under 810.
Okay. All right. Thanks a lot for that. Let's move to the F&O market now. Manoj Muralidharan is joining in to give us his view. He's the Vice President Derivatives at Relicare Broking. Manoj, good morning. How are you feeling about the market and what are the stocks you're looking at?
Good morning, Sonia. Sonia, I guess this has been 3 days of downtrend and 2 days of pullback that we saw at least in the last 5 to 6 sessions. Important levels, I believe, at least in the spot Nifty would be 19,650. I'm afraid that would not be breached because even the positions on the August futures are a bit less. Yesterday, there was almost some short covering. So I believe that Nifty might be drifting down today. A sell-on rise might be the trade. So if we get spot levels of 19,600 to 620, that becomes a good level to go short on the Nifty. The stop loss can be 19,680 on the spot and the target can be closer to 19,500. Stock specific, we believe that pharma is doing good and Cipla would still be a buy at somewhere close to 1220 to 1225. We recommend buying that. A stop loss of 1200 and it has a potential of almost 1265 as a target. From the cement sector, we believe for the August series, Ambuja is a stock which can outperform the entire series and even on the Nifty. So we believe that that is a stock that can be positive even for the entire series. We recommend buying it closer to 472 to 75. The stop loss in the stock should be around 465. And an initial target of somewhere close to 495 is what we're looking at in the stock.
Okay, well, we'll take a quick commercial break. Thanks very much, Manoj, for that. We'll come back. There's 4 minutes to go for the pre-open session. Your flashes at the bottom of the screen, and we'll talk about this when we come back. Hero MotoCorp has received more than 25,000 bookings for the Harley-Davidson X440. So that seems to be a pretty robust booking number. And that's interesting. I think the bike, the price was what, 2.5 or
2.4 lakhs, yeah.
So yeah,
Anuj is a buyer.
He is? We should have him back. All right, we have to take a break. So more on this in just a bit. Stay with us. Okay, welcome back. The Hero MotoCorp news flow, it's still at the bottom of the screen, 25,000 bookings. The point is the total value of this at about 2.5 odd lakh rupees is what, 625 odd crores. So that's the overall number. Although to book, maybe you have to, to put down the whole amount. So we'll have to see, finally in terms of how much does this lead to conversions. But this is a strong number indicative of the very strong demand that we have for this particular product. As Nigel points out, our colleague Anuj is already...
I can't wait to see. I can't wait to see that one, right? But this premium end of the market is really firing up.
Yeah.
I mean, I think in the last couple of days, across industries, people are telling us that, you know, premium stuff is selling so much. I mean, we just heard Kolte Patil say that premium houses are selling. Now premium bikes are selling. Hotels are full. So I think this luxury market is really getting its fair share of attention now.
Oh, yeah, it is. Everything premium, absolutely. Well, let's come back to that in just a bit. And maybe we can get an analyst to talk about this in terms of what this means for the stock in a bit. But Computer Age Management, CAMS, is the stock which is on our radar, the company which is on our radar. Their first quarter revenue was improved both sequentially as well as on a year-on-year basis. They saw high SIP registrations and inflows. That's basically the bulk of their business. Anuj Kumar is Managing Director and CEO at CAMS. He's with us to take some questions. Anuj, great to have you with us here. Good morning. Appreciate you joining in. You know, I just want to start with while overall numbers are better, you have seen a sort of fall in mutual fund yields, and that has perhaps pressured the core business a little bit. Could you talk to us about what yields will look like going forward? The last time you were on, we discussed this TER business quite extensively. At that point, you said that if those rules were to go through, that would see your numbers would get impacted by about 5% or so. Since then, there have been developments. There is a new consultation paper which is going to be put out, etc. Could you tell us, what's the road ahead for yields on the core mutual fund side? Go on.
Sure. Good morning, and thanks for having me over. As far as yields are concerned, I think there are two components to what's happened to our business. One, we did reset prices for one or two key customers in the last about 6 quarters, which is the impact you've seen in the past. That process is ending now. So that process closes out this quarter, which means we are not expecting yields to kind of contract from where they are right now. So that's part one that's specific to CAMS. On a broader level, we'd spoken about this last time. You've seen that as part of the last process of TER reset or a contemplated TER reset, SEBI has come out with a new set of consultative guidelines in terms of what they would expect to do. A lot of that is benchmarked to real yields that mutual funds had in the industry in 22-23. So if that is a benchmark, our clients will not undergo a fair bit of contraction, and therefore our position remains the same, that any impact on us would be perhaps 1 or 2%. So small single-digit impact, if we see anything at all, coming out of this set of TER-led yield contractions. That's where
Last time you were on, you said 5%. Now you're saying 1 to 2%. If this current set goes through.
Because there is a radical difference in architecture in terms of what was being taught earlier and what is being taught now.
Okay. Let's talk about the numbers then, because I want to understand what kind of a growth trend are you looking at. In Q1, your AUMs grew about 13% sequentially. And I think earlier you had guided for the revenue growth in FY24 to be in mid-teens and margins of over 40%. Do you stand by that? And what could the subsequent quarters look like in terms of growth in AUMs?
So what happened was that in the first 4 months of the year, our mutual fund assets have grown about 4 lakh crore. That is perhaps the best that has happened in the last 6 or 7 years. 1Q did not see all the benefit of that because the expansion only started in April. So the 1Q revenue came at 260 crore. Our expectation is that if things go on track, our 4Q revenue could be in the range of 285 to 290 crore in a broad way. The 1Q EBITDA stands at 42%, and we believe that if revenue expansion continues the way we are expecting, and the 4 lakh crore of assets continue to yield in the next 3 quarters, then EBITDA yield could expand a little, let's say, to be in the 43 to 44% range by the time we get to 4Q.
All right. Hi, Mr. Kumar. Good morning. Well, your non-mutual fund revenue has shown strong sequential growth of around 20%. What's the outlook here? I think the target you have is the contribution coming from this segment will be around 20% in the next few years. How do you see this segment growing?
We've seen good growth. Of course, there was a small component of acquisition revenue. The Think 360 revenue started getting consolidated in the first quarter itself. That's about a 5 crore contributor. But overall, we saw over 40% year on year, 20% in sequential quarters. Our payments business grew by about 25% year on year, alternatives by 19%, KRA by almost 40%. So as we focused on product development and go-to-market, etc., and these 3 or 4 businesses, we expect that non-mutual fund should continue doing better. We are at about 12.5% contribution. We expect that by the end of the year, this should get to about 14.5%. Within this, insurance hasn't kicked in yet. As you know, that the final regulatory dispensation of mandatory DMAT hasn't yet played out. So that hasn't really performed to our expectations. That could be on top of whatever I'm saying.
Sorry, that is the insurance repository. For insurance policies. Okay. Got it. So 14.5% share from non-mutual fund business by the end of this year, and your earlier guidance is 20% by FY27. That remains intact?
That remains intact. I think we could hit that number a little earlier, perhaps 4 or 5 quarters earlier.
Okay. All right. What about margins in the non-mutual fund side? Could you talk to us about that? They will be substantially lower than the mutual fund side, right?
So scaled businesses are delivering 40% EBITDA, which means our alternatives business delivers that much. Payments delivers about 30%. So as we scale these businesses, they will get to that number. Today, if you see consolidated non-MF, it's about mid-20s EBITDA. Do keep in mind that we continue to fund businesses like Account Aggregator, MF Central, and insurance right now, which means they're not net positive. So the impact of them, turning net positive and the other businesses scaling to closer to 40. In the next about 2.5 years, we think that non-MF should climb up from 25 to about 35%. And of course, company level, we've guided that we would like to maintain EBITDA margins between 40 and 45.
Okay, all right. And just a little more about this non-aggregator business, if you can tell me about, the account aggregator business. Can you tell me about what kind of revenue potential does this account aggregator business have? Not now, maybe over the next 1 to 2 years?
So you've seen that there is a rapid adoption across the board, especially from lending and now from personal finance management and capital markets. Multiple use cases have emerged. So it is fair to assume that at a steady state, this could be a market between 500 to 1,000 crore, let's say in the next 6 to 7 years. But it's a crowded market. There are 12 licensed account aggregators and many, many TSPs. So while it looks like a promising market, revenues will be fragmented. Single large dominant share players will be tough to find.
Okay. Just one clarification. You said to get 20% of revenues from non-mutual fund side, but with the early guidance for FY27, you said you may get to it 5 to 6 quarters before. Or there was that month?
Quarters before.
Okay. So by FY26, you should be at 20% then.
Yeah, we are kind of pushing the pedal to get there.
All right, got it. Thanks very much, Anuj. Appreciate you joining in, and it's always a pleasure having you with us on the program. That's CAMS stocks, about 1% higher right now. Well, I think the pre-open session is at I think we've done with the pre-open, and let's get the 9-10 calls out of the way. Sudarshan is back with us. Sudarshan, what do you have?
Sun Pharma is a buy with a stop under 1130.
All right, and Mitesh?
I'll go with a buy on TCS with a stop at 34.50 for targets of 35.60.
Okay, thanks a lot for that. A couple of stocks that you need to look at in pre-opening, right? PB Fintech will be an interesting one because the company has reported an operational profit versus a loss last year. So PB Fintech should come in on your screen 2.5% higher. You have Godrej Consumer that had a volume growth of over 10%, so the street would definitely like that as well. But Gland Pharma is something that you need to look at. Ekta is here to tell us why. Ekta.
Thanks for that. Well, it is going to react on what is a recovery which has come through for Gland Pharma this quarter. So the revenue is up 41% on a year-on-year basis. Margins have come in at 24%, but the street was anticipating 22%. Profit of 169 crores versus estimates of 166 crores. And there has been a Q-on-Q recovery because last quarter the margins had hit all the way had come down to around 21%. So there has been a recovery which has taken place both on revenue, margin, profit for Gland this time. Now, in terms of geographies, what has led the recovery is the US markets. It's up 25% on a Q-on-Q basis. It saw improvement in key products in terms of volumes. Pricing pressure has stabilized. India also saw growth of around 29% on a year-on-year basis. Rest of the world was up 193% on a year-on-year basis. Brokerages are positive. So Bernstein has an outperform rating. They say Q1 points towards an early sign of revival in the base business. Nirmal Bang has upgraded the stock to accumulate from sell due to an improved US pricing scenario. Citi still has a sell. They say that the recovery has also been driven by new launches in the US and market share gains in existing products, which is a positive. Remember that the stock is already corrected close to 50% from its 52-week high. It's trading at around 19 to 20 times 1 year forward. So there is definitely upside based on these numbers for the stock to probably see some amount of momentum.
Okay, thanks a lot for that. By the way, India Glycol has reported a very good set of numbers. So that stock actually in pre-opening is doing pretty well, up almost about 5%, I think, India Glycol. So just look at that. But Hero MotoCorp will also be in focus. We were just discussing how the Hero Harley new launch has done very well. It's the Harley-Davidson X440, which has received 25,000 bookings. And 65% of the bookings that have been received is for the high-end variant, which is priced at almost 2.7 lakh rupees, which just goes to show that the premium end of the market is surging now. The management says that they are delighted with the customer response, and the confidence that we are seeing in the higher end of the market is very heartening at the moment. The top-end model, that is. So clearly indicating that the customers are willing to pay a higher price for a good brand and a good model. All right. So that is on Hero MotoCorp. More on that later. But Sonal is with us to tell us why Tata Chemicals should be on your radar. Sonal.
Thank you so much for that. Well, Tata Chemicals reported numbers yesterday. The margin picture looked better than what the street was working with, but they just conducted a conference call and they spoke about near-term challenges. To take you through the numbers, first up, revenues were up 6%, EBITDA was up 3%, margins at 24.7% was better than estimates of 23.2%. Profits declined on a YY basis. This EBITDA was the highest ever for the company in ever actually. The company said higher revenues came in on account of better realizations. However, volumes were impacted. Their net debt also increased on a quarter-on-quarter basis. Morgan Stanley said they reported highest ever EBITDA and it offset the weak volume performance across geographies. India and US led the beat this time around. But the company in its conference call did say that net supply of soda ash has increased post-China reopening. There is no domestic China demand and that's why they are dumping goods in the global markets. Oversupply in the soda ash market has come in earlier than what they expected. Domestic supply was also impacted due to higher imports at cheaper prices. There have been delays by clients globally in terms of inventories as well, and globally there has been an impact there. Demand, however, remains strong in medium to long term, but short-term challenges remain, and they say short-term could be anywhere between 9 months to 15 months. They say we will have to see how demand in China pans out because real estate demand there is very weak. So it is a wait and watch mode for Tata Chemicals in terms of soda ash pricing, and that is something the management is worried about as well.
All right. The stock's down about 3% in the pre-open session. Sonal, thanks for that. So interesting one. We should also look at the other one, which is GHCL. That is a pure soda ash company, because these comments from Tata Chemicals are broader comments about what China is doing with their capacity. GHCL perhaps is the other one, which also should be impacted. So 541 right now, not very much. Tata Chemicals is moving. Let's look at the other names, right? Let's look at RateGain, for example. That reported numbers in the last hour. Numbers were pretty strong, and there are some upgrades from brokers like IIFL, etc., which are coming through. Stock starting about 1% higher. It did shoot up about 10% yesterday and then cooled off, closed about 5 or 6% in the green. MedPlus is another one. It's starting slightly lower. I think there are names like Indigo Paints, etc., which also reported numbers. Max Healthcare, perhaps we should have that up as well to give us an indication of how the pre-open is treating these names. Max is the other company. The management joins us in a bit from now, 1% higher. So it's a quiet kind of a start on some of these names, Sonia.
Okay, and you know what? I think I'm watching out for a lot of these platform companies very closely, especially after PB Fintech's good numbers. The core online business for PB Fintech has improved substantially. Revenues have gone up almost 40%. And the EBITDA on a quarterly basis has been consistent at 50 crores plus. So that's something that the street has definitely liked. In fact, all the platform companies, right? Zomato, Paytm, Delivery. Zomato, I think third day running is doing pretty well. So that stock is up almost about 0.8%. Let's not forget, Citi raised their target price on Zomato to 115, saying that it was a stellar show both on margins and on growth. So just a couple of these platform companies that you'd want to look at. But this morning, the first tick on the index is in the green, up about 30 odd points. The sensex is up about 76 points as well. The big mover, really, the big gainer is Hero MotoCorp, up 1.5% on the back of a solid booking coming in for their new Harley Hero bike. HUL, Tata Motors, SBI, Titan are a couple of other stocks that are looking pretty good at the moment. And NTPC as well, holding up in the green. Divi's Labs, I was telling you earlier that, this year, Divi's Labs is now up 15%. This week, it's up almost 5%. This month, it's up almost 7%. So good going there. By the way, Gland Pharma is really the stock to be in the broader markets. Very good set of numbers. So that stock is up almost about 9% now. Clearly the stock of the moment. On the downside, though, you have Power Grid, Britannia, Eicher Motors, Adani, Infosys that are just a tad bit in the red. Adani Ports comes out with numbers as well, so keep an eye out on that. ONGC, IndusInd Bank are a couple of other names. So largely you'd have to say it's a quiet start, but definitely all the action is in the broader markets. PB Fintech, Gland Pharma, Max Healthcare, all reacting to a good set of numbers.
Well, that's right. Let's focus on a couple of other names. ITD Cementation, those numbers look quite good. So that stock, in fact, was up close to around 5%. Volumes as well quite high in pre-open. So let's get ITD Cementation up for you on the screen. Zentech, second day running, that stock is up close to around 8% in pre-open. Yesterday it was up close to around 10% on the back of good numbers. So that one should come up for you. Peninsula Land as well as On Mobile Global. Normally we don't talk about both these two stocks. Both of them had come out with numbers yesterday. So both of them in fact up for you on the screen. GIC Housing in pre-open was under some pressure. It's had a bit of a run from the recent lows. Monte Carlo as well was a little bit tepid in terms of its start. So you should get Monte Carlo as well. Electra Green Tech, the stock has been all over the place. Went almost to around 1,500. Then it came down to around 1,100 approximately. Monte Carlo is getting a hard knock. Actually, it's down close to around 10%. Electra Green Tech as well is down close to around 5%. And Rainbow Hospitals as well. The children's arm, well, that had a big re-rating event from 500. It went all the way closer to around 1,000 rupees odd. But I think this morning, the start at least was a bit in the red, down close to around 2% odd.
Okay, well, Gland Pharma is the big mover today, isn't it? 9% higher, and it's coming up with very strong volumes as well. So 1462 on Gland Pharma, and there you go. That's a mover. Smaller railway, Railtel, for example, 4% higher. Hero MotoCorp, right? We were talking about those bookings for the premium bike. Stocks starting about 3% higher, 3,032 on Hero. We've got BEML, which is starting about 6% in the green, strong gains. We mentioned ITD, all these cable companies, Universal Cable, Birla Cable, Phoenix Cables, these were all up between 8 and 10% yesterday. Birla's coming up with volumes, 3% on this one, Birla Cable. Indigo Paints, results reaction, 3.5% higher. Texmaco Rail is up 3.5%. Inox Wind, 4% in the green, 219 on Inox Wind. There is KEI, which is up 3%. Right out of the gates, huge volumes. Rate Gain is up 2%, 2.5%. There is Action Construction Equipment, which is up about 3.5% as well. So this is, a good-looking buzzing screen that we have at this point in time. Yatharth, which is the company which listed yesterday, had a strong debut, starting 2.5%, 3% lower this morning. And Max Health is down 2%. So 570 on Max Health. So that's the other one. Tata Chemicals is down about 1.4. Sonal was just highlighting commentary from the call. And PB Fintech is down about 2% as well. So that's basically what you have. GIC Housing Finance, that's down 9%. 185, 186 on decent volumes for this point in the day. So that's another one that I just want to kind of mention. 13 points on the Nifty, so it's flat, 19,612, almost at yesterday's day's high, but it's a small but positive start. Harsha Upadhyay is Chief Investment Officer, Equity at Kotak Mutual Fund. Harsha, great to have you with us here. Thanks very much for your time. Good morning. What's the broad kind of focus or sort of thinking about markets at the Kotak investment team, Harsha? Are you guys still a little cautious about the run that we've had? And of course, we are well into the earnings season, so perhaps you have a bird's eye view of how earnings have panned out. That has also been one concern for you for the last 2 quarters at least. Go on.
Good morning, Prashant. Clearly, the earnings season has panned out more or less in line with expectations, I would say. Nearly 80% of the companies from the Nifty basket have announced results until now. And I would say a majority of those have either met expectations or have exceeded expectations. Not by a large margin, but by a small margin. So to that extent, the bias towards companies which have seen either stable earnings growth or slightly a slight bit of upgrades is higher. So we believe that the confidence in terms of reaching those mid-teen kind of earnings growth for the next 2 years on the Nifty basket is definitely quite higher, given how this earnings season has panned out. Having said that, we should also remember that we have seen very, very strong inflows from foreign shows for the last 4 months, which has driven the markets across the board, not just large caps, but more so in case of mid and small caps. And to that extent, the valuations have definitely moved up higher than our comfort levels, at least in the immediate term. So to that extent, we continue to remain a little cautious on the markets.
Okay, continue to remain a little cautious on the market. By the way, the big Nifty gainer right now, the biggest Nifty gainer is Hero MotoCorp after that fabulous response to the Harley-Davidson X440. Remember, the bookings will be, the deliveries will start from October of this year, but they've already received almost 26,000 bookings for the new Harley-Davidson. But just want to point out that if you compare the performance of Hero to Bajaj Auto, right, Hero has seen a big underperformance this year. The stock is up 10%, while Bajaj Auto is up 30%. So it's definitely playing catch-up to some of its peers in this space. Harsha, thanks for joining in. I wanted your thoughts here because the premium end of the market is definitely picking up, right? Not just in two-wheelers, but across real estate, other pockets as well. How are you feeling about that, and what's the best way to play it?
Definitely, when you look at consumption basket, the premium end has remained quite resilient all through the COVID period as well, I would say. And even post-COVID disruption, we have seen that basket doing relatively better than the rest of the consumption basket. And our thesis on two-wheelers is definitely we have seen some of the large disruptions in the market in the recent parts with electric vehicles coming in, with margins going down, with no new product launches affecting the consumer demand, etc. And at the same time, even the valuations had taken a knock in this basket, and just in line with what had happened the overall automobile sector, as well as, in particular with two-wheelers. Now that we have seen new product launches, now a little bit of stability on the volumes, and as we know, most of the manufacturing segments, including two-wheelers, will gain from moderating inflation on the raw material side. We should see better earnings growth from this basket, and that's what the market is reacting to.
Hi, Harsha. Morning. Good to hear your thoughts as always. Harsha, what do you make of these new age themes? They were down and out, but some of them have come back in style. They're making the right noises right now. The management commentary as well is looking up, and they're on their path to profitability. Do you like some of these stocks in there, and what would be your pick?
Nigel, I can distinctly talk about two phases in the past. One was just around the time when most of these companies got listed. There was complete euphoria, not just in our markets, but across the board, across geographies, and that led to euphoric valuations. And later on, we had valuations coming off across the board, and more so in terms of the high-tech or the internet companies in other geographies as well as our markets. We did see a lot of other overhangs also playing out in terms of existing shareholders selling out, some management changes in many of these companies, etc. Now we have seen a little bit of stability, at least in some of those companies. Obviously, it's not a homogeneous basket. So to that extent, we'll have to evaluate them on a bottom-up perspective. But those companies which are delivering on the promises made earlier, those which are moving towards path to profitability with a visible roadmap, are the ones which will probably tend to outperform the rest of the basket, in our opinion. So I think the one-way move upside and the one-way move downside were things of the past. Now on, it will be based on how these individual companies will perform going forward, and that's what will determine their stock performance in our.
Harsha, I wanted to ask you about small caps. I reckon there also you kind of take a sort of stock-specific kind of view. But again, the up move in the small caps particularly has been dizzying, right? As someone was joking, it's like 0.5% daily compounding. It's literally been that for a while. What do you make of it, and what is the approach broadly now at Kotak? If you can kind of provide us with some granular details about your thinking.
Prashant, you're right. I think if you look at the small cap basket, that has done much better than the large cap basket. And most of the foreign liquidity that we have seen in the recent times has moved into mid and small cap basket. Not so much into small caps, but definitely into mid caps. And we are continuing to see that liquidity coming in. And at the same time, we have also seen a definite shift in terms of the SIP numbers within our domestic market, wherein a large proportion of investors have tilted towards mid and small cap SIPs. Rather than large cap oriented funds in terms of SIP investments. So overall, given that the fund flow has been very, very strong at this segment of the market, and the fact that these are not very liquid, we have seen a kind of a larger move as compared to large caps in this basket. And clearly, as I mentioned, the earnings delivery and the sustenance of flows will be very critical for this basket, more than what you would say for example, large caps. So to that extent, they continue to remain more expensive than large caps. But yes, if you believe that there is an earning cycle which has turned around, and over the next 3 to 5 years, India is going to do much better than the rest of the economies with more of the segments participating in that growth, then definitely even small caps would be an interesting area. But at the same time, one should remember that given the kind of very sharp up move that we have seen in the last 4 months or so, it cannot be a one-way market from here on. One has to prepare for some volatility at some point of time in India.
What are your thoughts, Harsha, on what's happening with the banking space? The banks are just not performing, and there's of course one theory that perhaps the best of the banking performance in terms of earnings is now behind us, and margins are going to moderate from here. Would you sort of agree with that view? And if yes, would you churn out of banks and into any other sectors?
Sonia, I think clearly the ownership has been the single biggest factor driving the performance of banking stocks at this point of time. While, as you rightly mentioned, the results have been very, very strong, we have not seen commensurate stock performance, since most of the institutional investors already have kind of a reasonable exposure to this segment. While margins are definitely going to look a little softer going forward, we still believe that the earnings growth for this basket is going to be better than the average market earnings growth that we would see. So to that extent, we cannot say that this segment is going to underperform over the next few quarters. But at the same time, I think the kind of outperformance that we have seen from this basket maybe is going to moderate. So to that extent, there cannot be a uniform kind of a rally in this segment, which is true for the entire market in our view. Most of the market segments, most of the sectors have gone to elevated levels of valuation. So to that extent, we cannot expect a uniform kind of an up move from here on. It has to be more stock specific.
Harsha, what about the old economy stocks, cement, infrastructure? How do you play them? Getting into election, you see some bit of ramp up, some increased spending as well. What do you like from these themes?
We continue to remain very positive on this basket. Even though we had COVID disruption over the last 5 to 6 years, we have seen overall investments doubling. That is private capex and public capex. When I say public capex, center and state put together, this entire aggregate number has almost doubled in the last 6 years, despite the issues that we have seen in the economy. And there is no reason to believe that this kind of a growth rate cannot be met over the next 5-6 years. In fact, it's going to be much higher. And also, if you look at the immediate near term, there's an election coming up. So to that extent, most of these investments which are earmarked for growth will also go into many of those projects in the next 3 to 4 quarters. So clearly, the demand is likely to remain very, very strong for this basket. We do have a very positive opinion on that. Some of these subsegments had seen a bit of an earnings growth issue given what had happened during COVID, and also because of the cost inflation that had come through over the last 4 or 5 quarters. Now that the inflation is moderating, we should definitely see a larger profitability move as compared to overall our top line growth in some of these segments. And that's what we are excited about.
All right. We'll let you go on that note, Harsha. Thanks a lot for joining in. Appreciate your thoughts here on CNBC TV18. That's Kotak Mutual Fund. By the way, a lot of stocks actually in focus right now. Gland Pharma is really your stock of the moment, up 13% post numbers. But let's connect with the management of Max Healthcare. Very strong numbers. Across the board, actually, hospital companies have been doing very well. Good revenue growth, average revenue per occupied bed has also surged, but the occupancies are at the lower end this time. Abhay Soi, the Chairman and Managing Director at Max Healthcare, joins us now to talk about that. Abhay, pleasure speaking to you. Thanks a lot for joining in. Can you start by telling us what the guidance is on the revenue and the average revenue per occupied bed? Wanted to understand what are you expecting going forward, because on a quarter-on-quarter basis, occupancies were a bit flat. But what do you see in the subsequent quarters, and what is the growth that you can eke out?
So quarter-on-quarter occupancies were flat, like you rightly pointed out, but do keep in mind that the fourth quarter is the best quarter in the year for hospital companies, and the first quarter tends to be the weakest quarter of the year. In fact, usually the gap ups are a lot more than this. I'm quite happy to sort of look at the occupancies in the current quarter compared to quarter four. I mean, you'd see there's an increase Y-on-Y as far as occupancy is concerned. And on, like you rightly pointed out, on a quarter-on-quarter, it's sort of flat or marginally 1.9% lower. But like I said, that's true to the seasonality of hospital plays. We're expecting it to pick up like it does every year. I think if you just take the exception of the COVID years, of course, but otherwise you'll see a secular trend up as far as occupancies are concerned.
Abhay, hi, good morning. What about margins? I mean, can we extend that same point about the seasonality of it there as well? Because margins were down, I think, about 260 basis points Q-on-Q, and they were down some 15 basis points year-on-year. How would things look from here?
Look, I think, there's something I don't focus on is margins. What I look at is absolute value, which is EBITDA per bed or EBITDA. Because the moment you start doing high-end business, be it on the clinical side or the payer side, you have lower margins, but you have higher amount of absolute value EBITDA which is coming in. So, case in point is that you'll see, our international business has grown by more than 31% year-on-year. And international business is high ARPOB, is high overall EBITDA per bed and high absolute EBITDA. But, on an overall basis, there's lower margin. So if you look at, some of the other things that we've gained from, which is oncology, we've looked at, you look at cardiac sciences, robotics, which is more than doubled over the last 1 year. All of these are low percentage margin businesses, but high absolute terms. So, I keep saying this, you'd rather do a $10,000 surgery at a 20% margin than a $2,000 surgery with a 50% margin. And look, you see that as far as ARPOBs are concerned, and you see the result of what I'm saying as far as EBITDA is concerned, because you had a massive increase over last year, year-on-year, as far as EBITDA is concerned. And yet, compared to quarter four, which is the best quarter in the year, like I mentioned earlier, and quarter one being the weakest, that aside, you still have a flat EBITDA Q-on-Q, which in my memory, I mean, pre-COVID, has never happened before. So quarter one is always lower than quarter four, because on 1st of April, you have salary increases, etc., which typically need to get absorbed through the growth, which happens through the year. But this is the first time that we're seeing that it's flat. So I'm very, very sort of encouraged about future quarters.
All right. Hi, Abhay. Good morning. So what should the EBITDA per bed look like then? On a broad range, if you could give us. And also the international business that you mentioned, it's growing very, very well, more than 30% on a year-on-year basis, 9% of the revenues. Has the Afghanistan, which was a key market, has that come back?
Well, I mean, fortunately, unfortunately, this is in spite of Afghanistan not having come back at all. So our business from Afghanistan is zero as we speak. And we're expecting it because we've seen some flights which have started recently, very, very recently from Afghanistan. So we are hopeful that in the coming quarters, this business should come back. This used to be about 10-12% of our total international business. So we are encouraged by, like I said, these maiden flights which have just started recently, and we are hoping this business comes back soon. I will not be able to give you a guidance as far as EBITDA per bed or revenue, because I sort of normally stay away from guidances.
Sure. Yes, we know that. But I wanted to talk a little bit about the diagnostics business because, there's so much happening there. There's so much competition as well. But you folks have managed to eke out what? Almost a 39% growth, double-digit growth across the board. In your diagnostics business, in Max at Home business has grown 24%. Are you profit-making as well? And what kind of growth can you see in the diagnostics business here on, considering that there's so much competition now?
We've seen a 35% growth for the last 5, 6, 7 years in the diagnostics. Of course, it's on a smaller base. Like you rightly pointed out, you had a very good year-on-year growth, but even on a quarter-on-quarter basis, Dunia, we've grown by 10%. This is over Q4. So yes, this business is doing well. We're hitting the ground hard. We believe there's a space for hospitals because of the higher value proposition that we're able to provide through our labs, which are state of the art, and where it's manned by professors, it's manned by DNB students, and so on. And what we are being able to do is convey that excellence, in the perception as well of the hospital. So it's sort of working for us. And we are quite, I believe Max Lab and Max at Home, both, and by the way, both are profit making. Max Lab a little less so, and Max at Home does a mid-teen sort of a profitability. These are large businesses of the future, and we are very sort of hopeful about this.
Taken some price increases as well, right, Abhay, in June, especially on the radiology side?
Sorry, I missed that.
Abhay, you've taken some price increases as well on radiological imaging. Large number of tests have undergone price revisions?
No, so I think there have been two things. Every year on the 1st of April, we have price increases, which are usually about 2.5% of our top line impact. But what has happened in June is CGHS, which is the central government health scheme, that is, or the institutional business that we do. The government, after 40 years, actually has revised rates as far as diagnostics and room rents are concerned. Combined, this doesn't move our ARPOB by even 0.5 or 0.6%. So it's not a big market. Yeah, so the price revision in the CGH has happened because we haven't revised the price, the government has revised the price.
Okay.
And like I said, but it's a very, very marginal increase on ARPOB and our revenue. It's less than 0.5%.
All right, Abhay, what do you plan on doing with your holdings? You had KKR who exited a few months ago. Now you're the largest shareholder with 23% odd. Do you want to cash out at some point of time, or do you intend to continue holding on?
No, I don't intend to cash out. I've never sold my shares and I've never levered my shares. Even at the cost of, potentially increasing my shareholding. So, that's not the sort of business I'm in. I'm not a private equity, it's an individual holding, and I'm seeing great potential. We're doing huge amounts of capex going forward. I'm seeing a flywheel effect. All the development which is being done by the government is, sort of winds between our wings, and the opportunity to sort of just participate in this development through investment in the capex, and the great opportunity that we have ahead. Is going to keep me occupied. And I'm short of 50 right now. It's going to be my 50th birthday, so
Abhay, the short point is we get that you're committed to the business because there'll be various analysts on the street who will talk about the stock, but you'll be the best analyst on your own business, and that's what we wanted to hear, right? You believe that there's good potential, so that clears the point. Final question before we let you go. Institutional business is around 29-30% of your total business. Any outstanding receivables, if you quantify that amount, or has the money been coming in?
No, so money's been coming in, and I think we've also recently opened about 130 odd beds at our Shalimar Bagh facility, and so we had to sort of be a little more accommodative as far as institutional business is concerned, because new capacity, the first sort of this thing is to occupy it. But if I look at the institutional business X, the new capacity, we're down to about 27%, so it's come down. And the government has revised rates, and they're scheduled to revise hopefully some more rates in the near term. So we have not been taking any significant actions as far as reduction of the business is concerned.
Okay, I like it when you said, you're short of 50 and you have still a long time to go. 50 is the new 40, isn't it? So we hope best of luck. I'm sure your, shareholders, stakeholders would love the fact that you continue to stay on and not looking to exit anytime soon. Abhay Soi, thanks a lot for joining us on CNBC TV18. All right, let's move on. Godrej Consumer reported a good set of earnings in Q1. Margins have expanded, the home care segment has grown 14% and organic volume growth has been good. Sudhir Sitapati, the Managing Director and Chief Executive Officer, is with us. Mr. Setupati, thanks a lot for joining in. Can you tell us from these Q1 results, what can you infer for the entire year? Will this kind of performance sustain?
I think we had a good first quarter. A lot of it has been due to some of the initiatives that we've done in category development to grow categories faster. That part of it will continue. But I think, household insecticide had a good quarter driven by some amount of seasonality that may or may not persist in the next few quarters. So I would say this has been an exceptionally good quarter, but we expect to have reasonably good results, perhaps not as good as this one in the next few quarters.
Got that. Then what kind of growth do you foresee for the year then?
If you look at our organic volume growth in India, it was about double digit. That is probably not the volume growth trajectory of the India business yet. We used to be in kind of low mid single digits. I think it's higher than that, but double digit, I think we've gone past that pip because of certain external circumstances. Our Indonesia and Africa business, I think, will persist and continue the way they've grown in Q1.
Right. Mr. Sitapati, by when can Indonesia get to a 500 crore per quarter run rate, and how much more will Nigeria's currency impact be?
I think Indonesia, the macros in Indonesia are quite good. It's one of those countries that is doing quite well in the last few quarters. And our business, after some turbulence, has started doing well. So I don't exactly know when we will hit 500 crores a quarter, but this is a business that I anticipate over the next few years to do quite well for us. Africa continues to be pretty high turmoil. Nigeria in particular had a very big devaluation last quarter. Some of that devaluation, the impact on our P&L will be optical, some will be real. That devaluation is, by the way, generally good for our business and generally good, I think, for the economy when the currency goes to free float. But Africa continues to be politically volatile, especially on the currency front.
Okay, Africa continues to be politically volatile. Where do you see gross margins, ad spends and EBITDA margins for the year? Any kind of trend that you can give us?
I think, we are constantly looking at our primary focus is volume growth. And we really try and push volume growth to the maximum possible. The EBITDA margins, what they are in FY24, the EBITDA margins are pretty similar to our historic highs, except that the shape of our P&L has changed quite a lot. Our gross margins are lower than our historic numbers. Our advertising is higher. But our costs are significantly lower than our historic numbers, roundabout coming to our historic EBITDAs. So, again, I think the important thing is volume growth. The important thing is to invest in advertising. And the EBITDA numbers, that come will be a consequence. Q1 is quite reflective of the EBITDA numbers that, at the current situation look quite healthy at about 20%.
All right, so when will the value and volume gap for soaps business narrow down?
No, I think in soaps, the Q2, the gap between volume and value will be pretty high because Q2 last year and beginning of Q3 last year was when oil prices peaked and soap prices peaked. And therefore, you've got a really tough base in terms of value. So there will be a pretty big gap in Q2 and the beginning of Q3 in terms of value and volume on soaps. The premiumization impact in soaps is not large enough as a category. It is not one of those categories that is rapidly premiumizing. And that is not big enough to counter-effect the impact of the price drops.
So what is the target for Raymond in terms of revenue scale-up and synergies from here?
Yeah, I think, Raymond's is very much work in progress, and we're quite happy with the progress that we've done. We first got to get the business in the right shape. We've got to reduce our inventory, we've got to reduce accounts receivable. All of these are very different from GCPL norms. So, in Q1, we did whatever had to be done. In Q2 also, we will do it. We hope that in H2, we will start seeing significant synergies both on the revenue line and on the cost line.
So what would the volume and margin impact of the 900 crore capex announcement be?
I think the capex investment of 900 crores, which is quite sizable over the next 3 years, it takes into account three factors. One, that we are bullish on our volume growths. We are seeing that our investments are paying back on volume growths, and we anticipate that our volume growths will be higher than our historic numbers. So we've got to put the capex for it. Second, we feel that the logistics costs of our business will reduce with this capex, and logistics costs now play a more and more important role. And third, we hope that with automation, our production costs, or our conversion costs as they're called, come down as a consequence of this capex. So the capex does about half of it is for volume growth and half of it is for efficiency.
Okay, thanks a lot for joining in and appreciate your time here. Let's slip into a quick break. On the other side, Hemant Jalan of Indigo Paints will be with us to discuss their Q1 FY24 earnings. Stay tuned.
Okay, welcome back. I mean, the Nifty is like a traffic signal, blinking red and green, not very much at all. Absolutely flat. 19,590 is where we're at, where we were yesterday by 3:30. Well, strong numbers from Indigo Paints. Revenues have come in strong, margins have expanded, and we have Hemant Jalan, Chairman and Managing Director at the company, now joining in to take some questions. Mr. Jalan, good morning. Great to have you with us here on the program.
Morning.
Here at CNBC-TV18. Prashant this side. So, the first question is, what are you doing differently for you to be able to grow at 3 times what the industry is growing? Has there been a new product line, some campaign? Because you're far outpacing what the industry is growing at.
Well, Prashant, go back 2 years in time to the time of our IPO and look at the 10 years that preceded our IPO, and you'll find that we always outpace the industry growth by a factor of 2 or 3. It is only in the year after our IPO that our growth kind of tapered off and came back to the industry bandwidth of growth. Last year, a year ago, we announced a renewed strategy to focus on the larger cities, as opposed to our erstwhile focus on the smaller towns. And, sometimes when you announce a new strategy, it does take a few quarters for the results to start manifesting themselves. And happy to see that we are getting our mojo back and returning to where we were of, not just 2x the industry growth, but maybe more than 3x the industry growth. Of course, we need to sustain it for a few quarters for the belief to come back in that we are going to consistently be doing that. But that's what we hope to do in the quarters ahead.
What about the current market share? What is it at right now? And how much do you plan to grow it by over the next, say, 1 to 2 years?
I don't think we look at the share prices.
The market share of the company, sorry. I meant market share of the company.
Oh, market share. Oh, okay. I thought you were to the share price. The market share is still very small. It is maybe around 2.5%. And therefore, the headroom to growth is huge. Obviously, we'd like to catch up with the big boys in the industry. In this industry, nothing is going to happen overnight. It is going to take time. And if we continue to outpace the industry growth, it would be a few years before we start emerging as a a possible number 3 player in the paint industry. So we take it one step at a time and keep increasing our market share steadily. Nothing is going to happen with a big bang. And that's where we intend to be headed.
So from this 2.5%, as you said, right, there's a big scope to grow. Are you looking at what, 5% by the end of FY24, double-digit market share perhaps in the next 2 years? You must have outlined some sort of target for yourself. And do you plan to gain market share at the cost of perhaps margins? I mean, could that be a strategy for the next few years as you penetrate the market further?
Growing at the cost of margins has never been part of our strategy. And if you look at the results for the last 8-10 quarters or as far as back as you can go, our gross margins have always been the highest in the paint industry, even higher than the industry leader by a very wide margin. Our EBITDA margins are close to being the second best in the industry, and so also our PAT margins. So growth at the expense of profitability is never in our DNA, and I don't think we intend to pursue that course. As far as what market share we achieve at the end of what time frame, that's a little difficult to quantify. But yes, in a period of 2 to 2.5 years, if we can double our sales figure, which would mean growing at a compounded rate of slightly over 30%, that is what we aspire to do. How far we are able to achieve that or whether we exceed that, only time will tell. But the headroom to grow is so large that it would be silly to target anything less ambitious than that.
Okay, all right. Hi, good morning, Mr. Jalan. Just to understand that, in the next few years, the target is you double your revenues. Will you require to incur capex, or do you have already the capacities?
No, we had announced a large capex 2 years ago in Tamil Nadu. That project has come to an end. It is under trial production phase for the last 1.5-2 months. We are just awaiting a few final clearances, which we hope will come through in another week or 10 days, after which we will declare commercial production. And that capacity should be good enough to see us for the next 2 years. But 2 years down the road, with the kind of growth that we are expecting, I think that we will again start facing a capacity bottleneck. So we have announced that we are starting work on a new 90,000 KL per annum water-based paint plant at Jodhpur, for which work has just commenced. And we hope that that would go on stream in about 21 to 24 months from now. And that should take care of our capacity for the next few years.
Mr. Jalan, for this year, that's in the near term, FY24, what kind of a revenue growth are you penciling in? And also margins, what should be the rough range from around the 17% odd for the near term?
I don't like to give a specific number guidance, but I think we'd be happy if we ended the year at, a 30% plus top line growth. I think as far as EBITDA margins are concerned, we'd be happy in a 19 to 21% bandwidth. That is what we strive to attain. And if that happens, then the PAT margins would obviously be somewhere in the range of about 13%. But I would shy away from giving very specific number guidances because they're somewhat dependent on the fluctuations in the raw material prices. At the moment, they are a little benign and they have been soft for the last few quarters. But that is something that is completely unpredictable. And should the raw material prices turn around and start going up, that could have a slight short-term effect on profitability.
You know, we have a bunch of other questions, especially competition, right? But we'll leave it for another time. We're out of time. So thank you very much for beautifully explaining the strategy and, what you aim to do at Indigo Paints. Congratulations on a very healthy set of numbers. We've got, 2% of the stock, 1626. Well, the market is not doing very much. So it's down 8 points or so. And things are on the flat side. Market breadth, broader markets, just fine. 1,250 stocks are higher, 770 stocks are lower. Mitesh is with us with a quick check on things on markets. Mitesh, welcome back. On the index, any trade and any fresh stock-specific trades?
Good morning again, Prashant. I think on the index, we have some put options. We are holding on to them, not adding on to the futures side, because I would want to short closer to about 19,650, and we haven't reached there as yet. So we'll either wait for a decisive breakdown on the hourly and the 2-hourly charts, or wait for this pullback to play out and then go short. My sense is that we might not be able to get past 19,700 on the Nifty, so 19,650, 660 is the preferred shorting area. Having said that, on the stock side, I have one buy and one sell. Nestle is something I think which is looking negative. It's breaking down. So recommend a sell here with a stop at 22,400 to 50 and a target of 21,750. And Biocon is something which is giving a breakout on the upside. So that's a buy with a stop at 265 for targets of 285.
Okay. Well, I just wanted to talk a little bit about Maruti and the fact that, Maruti will be acquiring SMG from Suzuki Motors. So Suzuki Motors Gujarat will be acquired by Maruti from Suzuki Motors, as we know that the news came a couple of days ago. Now, they have given us a lot of details on how that acquisition will be done. The board has approved a preferential issue of Maruti equity shares to SMC. And they say that the option of acquiring SMG shares by an issue of Maruti equity shares to SMC would be beneficial to minority shareholders and would be beneficial to Maruti as well. And hence, that's why you're seeing the stock up almost about 0.3%. They have said that there are three, options that they have evaluated. And in all three options, they speak about how the profits would be higher, the EPS would be higher, and the dividend payable would be higher. Three swap options is what they have put on board. So they have, given a very detailed analysis of what happens with the swap options and what the eventual impact would be. It's positive for shareholders, minority shareholders, as well as positive for Maruti, and hence, the stock is up in the
We'll have to wait by for the amount of dilution, right, Sonia? I mean, as of the last reported number, I think SMC's net worth was around 12,500, 12,700 crores approximately. If they do it at current market price, then it'll be a dilution of around 4.4% or thereabouts. So we'll be waiting for further details. This could have been done either by cash or by issuing shares. And as of now, they're tilting towards the preference share allotment route. Sonia will get us more details on that front. But for the time being, let's turn our attention away from the equity markets. Manisha is standing by to tell us what's going on in the commodity space. Morning, Manisha.
Morning, Nigel. Thank you for that. Well, I'm looking at the metal prices, which have seen a decline, especially after the China data that came in. The trade numbers came in on the much weaker side for the month of July. We've seen a double-digit decline for import and export numbers and much lower than what the street was anticipating. So the exports for the month of July on an year-on-year basis in China are down 14.5%. Imports also have declined 12.5%, and that is weighing onto the metals as a sector there. The steel prices, in the meanwhile, are trading at an 8-week lows. Iron ore has slipped to a 2-month lows, and copper is off its 3-month highs that we saw it trading in the couple of weeks ago. This is what we've done in the last 1 week in sense of many of these metal prices. So 2% down for copper in last 6 or 7 trading sessions. We've seen steel, zinc decline by 3% and 2.5% decline for aluminum. Iron ore continues to be your underperformer, 6.5% down in last 1 week itself. Within this space as well, I'm looking at copper because this is an area everybody says is going to be on the stronger side. The long-term fundamentals are strong. Remember, for a mine or a new project to come online, it takes 8 to 10 years. So the previous projects will come online this year and the next. But after that, post-2026, most markets believe that you are looking at lower supplies in sense of copper. Codelco, for one, which is the biggest copper producer, has revised output projection. For the first half of this year, we've seen Codelco output decline by 14%. And for this year now, they're anticipating output at 1.3 to 1.35 million tons or thereabout. The other important one to watch out for is that the U.S. Department of Energy in this week has added copper to critical material list. I mean, they perhaps have been the last ones to do that because when you look at the list of countries who've already done that, that includes India, Canada, Japan, and various major other consumers as well. European Union, China, etc. already have put copper on a critical list there. Other thing to know is that copper is used for clean energy generation, transmission, storage, photovoltaic cables, infrastructure, and EVs, etc. So copper demand going forward in the next decade is expected to double from where we are right now, and not so much copper is going to be available. But looking at the kind of economic data China is throwing up for the near term, that is what seems to be putting some pressure.
Okay, Manisha, thanks a lot for that. Let's slip into a quick break. On the other side of the break, Bhanu Chopra of RateGain Travel Technologies will be joining in to talk about the quarter gone by. Stay tuned.
Welcome back. Don't be fooled. The Nifty has not moved a single point, actually. It's more or less as flat as can be. But from the broader markets, plenty of stocks are moving around. RateGain is one such stock, and that's the next corporate on our radar. Revenues are up by close to around 80% in the first quarter. They aim to double their revenues in the next 3 years. To understand more about the way ahead, we're joined by Bhanu Chopra, the Chairman and Managing Director at the company. Hi, Bhanu. Good morning. Thanks so much for joining in, and congratulations on a solid showing in the first quarter. Now, what's the way ahead? Do you maintain that organic growth of around 20-25% or thereabouts, and also 55%, I think, for FY24? Do you believe on the revenue side, actually, you can outbeat this 55%? Also, margins, I think you were guiding for around 200 basis points improvement. So FY24, 17 to 18% doable?
Yeah, so first off, Nigel, thanks for having me on the show. So, yes, at the beginning of the fiscal year, we'd guided for about 55 to 58% growth and about 17% in margin. But if you look at our Q1 numbers, they've actually exceeded those targets. We came in at about 80%, and our first quarter margin, you know, we'd guided for about 13.5%, but we are at 17.6%. So if you take cues from Q1 and how we performed against the fiscal year target, so I'm pretty confident that we will beat the guidance that we gave. What the delta would be, I don't know. I can tell you, in terms of overall industry trends, you know, there is a lot of tailwind that's behind us, given, you know, the attitudes of people have changed. If I ask you, what is, you know, the next big thing on your list, I'm sure you're going to talk about travel. And that's how most people are reacting. So even though there's talk about, you know, inflation rates and also interest rates going up, we don't see any letdown in people wanting to travel. So if you look at our customers as well, they're doing extremely well. They're reporting record revenues and bottom lines, and they want to digitize. So I believe the best is yet to come.
Nigel, it'll be travel on a bike. So, you know, I can combine two things there. Well, Bhanu, good morning. Congratulations. Super set of numbers. Prashant here. You said you're confident you will beat the guidance of 55%, right, which you put out earlier. If you want to put out numbers, please do. What kind, by how much? Some broad way to think about it. How much of it will be organic? And on margins as well, is there further upside? 17.6% this quarter. What can we look at by the end of the year?
Yeah, so look, you know, as I said, we're seeing some, you know, dramatic moves by our customers in terms of, you know, their digitization needs. So it's a positive surprise for us. I mean, one of the things I will point to you is, you know, the fact that AI has become sort of pretty big on everyone's radar. And one of our business units is data as a service. And for any AI model, data is the key ingredient. So what we are seeing is all our targets are being surpassed because the amount of data volumes that these AI models need, you know, for decision support systems, you know, is going through the roof. So that's what we are witnessing. I can't put a number on, you know, what it will be. Like I said, I think I'll be able to come back and give you better guidance in the next quarter. But I can tell you, we're having another very, very strong quarter, the current one. And I'm very, very confident about beating both the revenue as well as the margin numbers of 55, 58% on growth and 17 to 18% on margins. On a steady state, something that I mentioned on the earnings call yesterday as well, you know, this business can easily be about 25 to 30%. But, you know, we've implanted a lot of seeds, and each of these seeds have huge opportunity to grow. So we want to continue to reinvest, but on a steady state, we can be a 25 to 30% margin business.
And you are in the right place at the right time, right? I mean, your travel and hotel software, I mean, how can it get any better? Especially at a time like this, I agree when you say that travel is the only thing on people's minds. And now, whether it's Agoda, Bookings.com, Expedia, and these are the guys that you service as well. I mean, their bookings are going through the roof. So tell us, any M&A plans that you have? You have some cash on your books as well, I think to the tune of around 600 crores or so. Any M&A plans?
Yeah, Sonia, so the cash on books currently is about 350. We've come out with a proposal to do a QIP for another 600. So On the M&A side, as you know, we are very, very active. We did the Adara acquisition, and that's gone extremely well for us. So we are an acquisitive company. We're looking at targets in these areas where we operate around DaaS distribution and MarTech. We have a very robust pipeline, but we are also fiscally very, very disciplined on what we are willing to pay. But I'm pretty confident. If you look at our track record, we've been acquiring one company a year since 2018, except for the COVID year. So, hopefully there'll be some news for me to share next time I come on the show.
We hear about this news, and out of, you have 300 crores, you're looking to raise 600 crores. So what could the acquisition size be? We're running a little short on time, but if you squeeze in a couple of numbers.
See, the sweet spot that we've had so far is around 150 to 200 crores, but there are a couple of opportunities that we are looking at which are beyond that. And I do feel that, there is enough opportunity in the marketplace, given the pipeline that we have, that we need to create a war chest, and that's what we want to do. So as you can see, our numbers are, in terms of profits and free cash flow generation, is very good. So it's really, using the money for M&A.
Okay, all right. We will come back to you when you have more clarity on, what the money will be used for in terms of a timeline, etc. But thanks a lot for joining us on CNBC TV18. Let's slip into a quick break. On the other side, Lata will get chatting with Devdatta Chand of Bank of Baroda to talk about the quarter gone by. Stay tuned.
Welcome back. We are continuing with earnings analysis. Bank of Baroda reported a strong set of numbers, 18% advances growth, 16% deposits growth. The asset quality excellent, annualized slippage ratio lowest in 11 quarters. Cost to income ratio is actually lowest in 22 quarters. Yes, the pressure on margins is what everyone noticed. But for more on the bank's results and its outlook, we have the person who has just taken over as the managing director, Mr. Debadatta Chand. Mr. Chand, thank you very much for joining us.
Welcome.
The first question really is this loan growth. It's Bank of Baroda's loan growth, 18% was very good. And we are getting the same thing even from other NBFC companies, 18 and 20% growth. Does it look like it can continue like this?
Yeah, Lata, I believe that we can continue the loan growth journey. The reason being, this is a very unique quarter, wherein the bank could optimize on the loan growth side, at the same time maintaining the margin almost at 3.3, at the same time giving a 88% growth in the net profit. So if I look at a couple of what you can say the main important aspect of the banking in terms of the top line, the bottom line, the asset quality and the margin. For Bank of Baroda, all four factors have come very good for this quarter. And that is what important part of the entire that we are communicating to the market, that the bank is trying to optimize on every front. And my sense that going forward also, since the demand is there in the economy, the growth would be possible to replicate for the consecutive quarters. But for a guidance, we have slightly given full year guidance slightly lower than the 18%. The reason being, at some point of time, the base effect also would start kicking. So the overall guidance to grow around 15% for the full year. But going forward for quarter to quarter, the growth can still be around 18%, which we have achieved in the first quarter.
Okay. No, that point is taken. You said margins are maintained. From year ago levels, you'll have maintained. But your fourth quarter margins were 3.53. So are you confident that you can even freeze it at 3.3? Because deposits will catch up. Liabilities always catch up. So there is a fear that it can come down to 3.2, you think?
It's a fact that the cost, there is a push in terms of the cost of deposit, and that has, if you look at the growth, the percentage increase in the cost of deposit higher than the last quarter. At the same time, we also say that there is a significant percentage of the MCLR books still to get repriced. Because all this 1 year MCLR get repriced at the end of 1 year. And since the repo rate hike was intervening below 1 year, so there is a bit of a portfolio which is there, which can still be repriced for the MCLR. The second aspect, we are pushing very clearly now that we also wanted to have a lower cost to income ratio. Although we are not giving any numerical target for cost to income ratio, but then clearly the bank started working on that. If you compare the YOY reduction in cost to income ratio, it is almost like 945 basis. If you exclude the MTM impact, then it is almost 166 basis. So a couple of things which again we are trying to figure out is to how to again create an efficiency in terms of the cost to income ratio. So I believe that we are guiding the market that we will be in a position to maintain 3.3% going by the outlook we have as on today. So any change outlook, things can be different, but currently we hold our guidance of 3.3% on the NIM side.
No, this is very important what you say about OPEX, because even your previous MD was telling us that they were able to bring down branches where it was coinciding with the banks that you all took over. And obviously, because Bob World is working, those are cost efficiencies. You think you can still optimize in terms of replacing retired workers or retired employees, or even branch rationalization? Even those spaces are available for you?
It's a holistic in terms of how do I look into the cost to income. There are two ways I need to look into. One is a case where I optimize my income side more. The other is to reduce the cost. So the cost matrix goes in terms of HR also, in terms of branch also, in terms of process automation also. The point that I have also said earlier is that as a bank, we invested heavily into the product side and also on the HR side. But now time has come to look into the process side also. So I believe all this would result into some kind of a better optimization on the cost to income, and that would help the bank to maintain its margin going forward.
Okay. What stood out about your post results, message to analysts is that you expect to grow overall 2% faster than the system, and retail you said you were expecting to grow, I think, 5 percentage points faster than the system. You're confident of that? And I'm asking you because there are 2 or 3 challenges. HDFC is with HDFC Bank, and that is cheap money and a system that knows how to give home loans. And then there is Geo Financial for consumer lending. So you still think retail is achievable?
It is actually. It's not like it's a 1 quarter we are given a 25%. If you look at last 8 quarters, the retail growth has been better than the market. And it talks about my delivery in terms of retail that is much more important. A couple of new things that we started rather a couple of quarters back, and now we are trying to optimize is the sales part of the entire retail. So we are strengthening the not only the credit delivery in terms of retail, at the same time we are also trying to have more sales executive to drive retail. One.
Okay.
Secondly, another structural change we have made in terms of our processing center. We had limited processing center in terms of retail with the same control.
Okay.
With the same control, we are trying to have more processing center, and that typically can reduce the lead time in terms of sanction. That is what we call it TAG. So with that, I believe the franchisee is working very well and continue to do same way, and will maintain that kind of a what we can say delta over market, and that is what will possible.
You are hoping to achieve. Okay, I'll tell you 2 or 3 fears that you hear from RBI and other banking sector watchers, that unsecured credit is a worry for the RBI. They've written to some banks and NBFCs. The second thing is, some people worry that retail is overcrowded now. You know, big banks are, some of them 65% into retail, and at some point the cycle turns. You know, some of them have already got very good retail history.
Yeah.
Some of you are new to retail.
Yeah.
So there is a fear that in the first cycle, will you have a problem in terms of asset quality?
No, let me tell a couple of data points before I come to the subject, that retail debt as a percentage of GDP is very low in India.
That is true.
So there is a huge upside.
Unmet demand.
Yeah, that's available. The second aspect is that the market significantly now moving from asset-based financing to cash flow-based financing, because people do have adequate cash, and for that they can service a loan in much quicker time as compared to earlier. And as far as we are concerned, I have an aging of almost 3.5, 4 years on the retail side now.
Okay.
Secondly, my portfolio is almost now 20,000 crore, which is also sizable in terms of looking into the portfolio side of it. But as far as Bank of Baroda portfolio is concerned, these are all existing customer availing, almost all existing customers.
So you
availing.
have data on that.
So we have the data on that. We have their cash flow, the life cycle, everything with us. And as on today, the percentage of NPA is very low as compared to any other retail loan.
That is true.
And when I compare, if I typically look at the growth, it looks high, but then my base is very, very low. If I compare the largest bank had a much higher portfolio as compared to the portfolio I do carry. So a scenario at which there is a change happening in the market, point one. Secondly, the retail debt as a percentage is quite low for India. Then I think there is a potential available therein. The only aspect that which the system talking about it with regard to that, whether I do have the adequate risk matrix to do the appraisal. And Bank of Baroda, we do have those kind of risk matrix to appraise and underwrite properly.
Oh, fair enough. That's good to hear. What's your sense about, the kind of recoveries you can get from NCLT? You have a decent number of amount of money in assets in NCLT, and plus now Go Air looks like it is recovering, but still there is a little bit of a red flag. So any statements you can give on asset quality? Annualized slippages now are among the best. But going forward, you think even the big loans?
Yeah. Couple of guidance we have given to the market. One is that to maintain the GNPA around 3.5 and the net NPA around 0.75, and the slippage would be around 1 to 1.25, and the credit cost would be below 1. So although NCLT is a kitty, because it all depends upon all processes they are in, so without getting into that account wise, but I believe all these numbers are achievable based on the current, what you can say, on the recovery that we are seeing and the slippages that we are seeing. We have also said that my recovery for the full year would be 12,000 crore.
Okay.
And we also said that the net slippage would be negligible, or the delta can be something around 2,000 to 3,000 positive. So in that scenario, I'm quite helpful to maintain all this guidance that we have given to the market.
Fair enough, fair enough. Your other, guidance to the market, or whatever, a positive that the market sees in you, is the recruitment philosophy in Bank of Baroda has changed from the time you had a lateral recruit as a managing director from the private sector. I think the only example I know of a public sector bank having a private sector head. Later on, you all had the chief digital officer, CFO, all of them from outside. You intend to continue that practice, and are you confident it's working well?
Yeah, it's working well, and I do believe the stance would continue. The philosophy behind this, or the bank stance, is that areas where, particularly a bank like us, a PSU, the market has moved ahead of us in terms of those kind of, implementation. We need to have somebody from outside to allow us to catch up. So areas where we as the PSU bank, we are not at par, we'll continue to have those wherein we'll have market expert who can again drive us to achieve those numbers. So the experiment Bank of Baroda, this process started something around 5 years back, and it's perfectly working. And as a stance and strategy also, I very clearly said earlier also, anything in the bank which is giving us positive dividend, as far as I am concerned, will continue on all those aspects which is giving positive dividend.
Okay, that's good to hear. Just a word on when we were talking asset quality, you had more provisions than people expected. You put some floating provisions. You will continue to do that?
See, that's why we believe that my only objective is to not to optimize on the profit side, but to also strengthen balance sheet. Right. The PCR is all-time high at 93 point something. So this would continue as a hygiene and strategy to strengthen balance sheet. So wherever there is a possibility for me to create some kind of a, bit of provision which can also give me a bit of comfort going forward for any headwinds that the market can see, then I think that's a proper strategy and proper, for the bank also comforting all analysts and all market participants for the matter.
Okay. Well, a final question on your capital. Will you want to divest in any of your investments in say NSE or anything that you may have, anything that you will do to your book, or will you even raise capital, because the market is very kind to banks now?
So rather my first point is that the PSU bank, we're in a very sweet spot at this point of time. And the performance for last, if you look at 8 quarters, these are very consistent. Rather, I would expect a re-rating of banks PSU as a pack rather looking at one particular bank like me at this point of time, point 1. Point 2, as far as Bank of Baroda is concerned, my CRAR is now 15.85. And
no, you don't need. I was only saying the market is kind, so why not take advantage?
No, we do have mandate to raise 81 and Tier 2 for 5,000, but since the CRAR is quite comfortable, we are not looking at any capital raise at this point of time. The second aspect with regard to a divestment, we as a bank pursue that actively at any point of time. But the final decision would be based on the conduciveness of the market and the valuation. So wherever my own subsidiary or wherever we have strategic investment, we always pursue for getting some of them monetized, but then all would depend upon the valuation and the market conduciveness.
Okay. No, I can understand waiting for better valuations for PSUs as a whole seems like a great strategy. Mr. Chand, thank you very much for spending time with us.
Welcome, Lata, and pleasure interacting with you. Thank you.
Okay. Welcome, sir. That's it from the BOB management. We're going to a break. It's time for Chartbuster.